Hello everyone, today on the final bar, sell the news. NVDA beats earnings, but initial gap higher is met with selling pressure. The stock gives back almost all of its early gains. The S&P and the NASDAQ 100 dropped the dreaded bearish engulfing pattern. What does this mean for stocks leading into Powell's press conference tomorrow from Jackson Hole? Finally, McLaughlin of AllStar Charts will be joining us from Colorado. What can we do in a period of sideways markets and elevated volatility? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's episode of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the power of technical analysis. The technical analysis toolkit really has been designed centuries ago, really, as a way to better quantify price action and give investors, give traders an opportunity to better understand market dynamics. As that toolkit has evolved, there are new and exciting ways to try to make sense of things. The computerization of market data, just the access to information that we have today more than ever. I will always tell people, though, having the access to information is not as awesome of a thing as you may think. A fire hose of information bringing you tons of stuff about every little movement is a lot of times paralyzing for investors. That's the dreaded analysis paralysis. What I find charts are really helpful at doing is cutting through the noise, focusing not on what could happen or should happen, not relating to all these different narratives and how they may play out, but focusing on price action. I think when you think about the narrative of AI and growth stocks in 2023, the prospect of higher interest rates and elevated rates, volatility increasing. At the end of the day, the charts will tell you what investors are doing, how they're voting with their capital. Are they excited, nervous, desperate, euphoric, despondent? All of those things, I would argue, are reflected in the prices of assets. And the charts that we can use on the Stock Charts platform hopefully really illuminate the movements in the market and the opportunities that they potentially present. We're going to talk today about some bearish engulfing patterns. We've mentioned these on previous shows, a lot of them today, and on names that are not encouraging. Number one, the major averages like the S&P and the NASDAQ dropping some. A number of these things are actually testing 50-day moving averages from below. And if I scripted out what a breakdown might look like, it probably would include this kind of day. And it's interesting leading into Friday's press conference from Jackson Hole with Fed Chairman Powell sharing his latest comments on what to expect from the Fed. We have a lot of charts to get to, so let's get right to it with our market recap. As we warm up the charts, let's answer a poll question. We asked you recently, what would you feel most comfortable shorting right now? And nothing was not one of your options. You had to pick one. So thank you for courageously putting some skin in the game here and picking one of them. Almost half of you, 45%, said the S&P 500. Other than that, we had bonds, gold, and Bitcoin. And Bitcoin was number 2 at around 28%. Then it fell off very quickly to bonds and gold. So we're least excited about shorting gold, and I'd probably agree with that only because out of those three things, bonds and gold are in the clear downtrends. They certainly have been in the downtrend phase, right? Bonds, the TLT, the ag, sort of testing support, and for the most part, I would argue failing to hold support levels, kind of continue to break down. Gold is actually potentially finding a bit of a floor there and bouncing a little bit higher to the upside. So I'd probably be not super happy in terms of the broader defensive positioning that gold could provide, but also the fact that it's been beaten down and starting to pop up a little bit. Stocks, as we know from a day like today and in recent weeks, rolling down from resistance and continuing lower. Bitcoin's sort of in that same thing. I'd probably say stocks as well here. Now, how long would you feel comfortable shorting them? My number one answer would be not long for any of those things. And I always remind people, if you are shorting anything, you have to remember you are fighting against centuries of stock market history. So shorting can be a valuable and powerful tool to benefit from the downside on a small time frame, on a tactical basis. It can be incredibly profitable. Being consistently short over time usually means consistently wrong versus the broader movements in the markets. But I digress. My shorting soapbox now exited. Let's continue on with the market recap and look at what happened today. Today, not a bad day to be short out of the open, to be honest with you, because we bounced higher. The S&P breaking above 4450, but then through the remainder of the day, it was sort of like a floor that couldn't be found. We kept slipping downwards and downwards. The S&P finishing down about 1.4%. The NASDAQ also, of course, in the red, down almost 2% today, finishing about 1.9% lower. And the NASDAQ 100, really comprising those mega cap stocks, down over 2%, finishing the day down 2.2%. Mid caps and small caps both down about 1%. So overall, this was the largest names, particularly the largest growth names, really pushing the way down. As we'll see when we get to the sectors here in a little bit, it was the growthy sectors at the bottom, the FANG sectors, really lagging the most today. The only green on this front page is the VIX. Volatility went higher, over a full point. So we're up to around 17.25 for the VIX. Again, if you look at the overall trend in the VIX over time, a VIX of 17 in certain years would be incredibly low, right? In 2022, if you talk about a VIX at 17, that's a fantastic low level relative to a VIX at 25, 30, 35. But in 2023, a mark of 17 is way above the low around 13 that we saw pretty recently here. So still relatively low volatility, but increasing. And I think that is probably one of the main themes that we will have to be dealing with as investors, certainly going through the remainder of the third quarter, if not further. Looking at interest rates, a big part of the weaker growth story, as we've been discussing with a number of our guests, are rising rates, or certainly elevated interest rates. The 10-year yield finishing the day around 4.24. Long bond yield just about 4.3%. The 5-year point at 4.4%. The short end of the curve, of course, much higher, with the shorter term yield around 5.3%. So that inverted curve that we've been talking about, one of the better predictors of recessionary periods that you can find, still sort of in that inverted condition. Bond prices, of course, coming down when yields are going up, and that is basically what we saw. The dollar index moving up a little bit to finish the day here. Looking around at other asset classes, the commodity space in particular, actually not a lot of change for commodities as a whole. The DBC was not too far off of Wednesday's close. Gold, also very similar. The GLD was just slightly rounding error down, but not by much, essentially unchanged for the day. Silver prices and copper prices down a little bit. Some of the energy space actually pushing higher with natural gas prices. The UNG was up about 2%. But overall, I would say commodities less active in terms of percent movements than other places. If you like the color red, cryptocurrencies, probably an interesting place to hang out today. Bitcoin down about 1.5%. Ether prices down 1.7%. Ether right around 1650, and Bitcoin is getting nearer and nearer to 26,000. I think that Bitcoin chart is a really interesting one because it's been in a basing pattern, right? And a basing pattern I would describe as anywhere you can draw kind of a rectangle around the price action, right? Think about 25,000 as at the lower end, probably 31,000 as the upper end. Those are the recent highs. We remain range bound. So you have to remember that markets can go up, they can go down, they can go sideways. And I think that larger term trend on Bitcoin is still sideways until we break out of that range. And for now, we appear to be testing the lower end of the range once again. All of the 11 S&P sectors finished the day in the red, and it got brighter red, I feel like, as the day went on. In terms of the sectors outperforming, meaning they were down the least on a day like today, financials, the XLF only down about 0.3%, materials and real estate both down less than 0.5%. On the downside, of course, we have the FANG sectors, XLK, XLY, XLC, all down about 2 to 2.3%. And so again, this today was about, I think, that initial promise of NVIDIA beating earnings. And I know on the show yesterday, we watched real time as we tried to digest what was happening initially after the earnings were released. Stock was up 7-8% in the after hours yesterday. That's a great reminder, by the way, to not trust what's happening in the after-hours session one day to what happens in the day session the next day. I think a lot of times investors fall into that trap where they think that there's a ton of signal in the after-hours reaction. You have to remember that is a lot less liquid, meaning there are a lot less participants, there's a lot less volume, and certainly institutional activity in that sort of period. The next open, right, the next trading day after earnings is when all the big participants are able to start to make changes if they feel that that's what's needed. So today, I think you're seeing the vote overall with NVIDIA gapping higher but trading lower pretty much consistently through the course of the day. Let's look at some charts that put a little more detail behind everything I just said. And let's start with a chart of the S&P 500. So as you can probably see, this isn't a candle chart, this is a bar chart, but if you've seen enough charts, this immediately just jumps off the page, what's called the bearish engulfing pattern. Or if you're a bar chart person, this would actually be called an outside day, a bearish outside day. And same idea, right? The outside day on a bar chart is basically an expansion in the range. So higher high, lower low from today versus yesterday. Yesterday was an up close, today was a down close. That's called a bearish outside day, and it's almost identical to a bearish engulfing pattern, which is using candle charts to illustrate that same kind of phenomenon. One day higher, the next day significantly lower. What's striking about this particular pattern at this particular moment is it happens right as we're testing the 50-day from below. And what I will tell you is if you asked me to script what would a market top look like in July, what are like the 3 things you would look for? And I would probably say something like an initial divergence, right? Some sign that there is exhaustion, some early red flag that things maybe were getting a little overheated on the upside. And of course, as we know, we had a bearish engulfing pattern there with higher highs in July and lower peaks in momentum there second half of last month. Then you get a breakdown through a key support level, and I would say the breakdown through the 50-day moving average, probably one of the most commonly followed metrics to just see, is this a brief pullback or is this the beginning of something more significant? I think the fact that we broke down through the 50-day on the S&P 500, on the QQQ, on a lot of individual stocks like Apple and Microsoft, very telling about the strength of the downside potential. Then the third piece would be some sort of confirmation. Once we break through the 50-day, what additional color do you get that validates the fact that we're in more of a distribution phase, that investors are not buying on the dips, but instead selling the rips? And I would say if you wanted a 2-bar candle pattern that best illustrated that idea of selling the rips, a bounce and then sellers kind of taking control, it's this. It's the 1 day up, next day down. That's a bearish engulfing pattern, or as I mentioned, a bearish outside day. All of those things now have happened. Now that doesn't mean that the S&P is going to go to 2,000, although that is theoretically possible. I don't think we're getting that sort of confirmation from what we've seen so far, but it certainly tells me that we're in that environment where we're selling the news, right? NVIDIA's earnings report was actually pretty constructive. The fact that we traded lower through the course of the day today tells me that that optimism has already been priced in. That AI growth is already priced into the price of NVIDIA. Today, it's more about recognizing that that is now a long-term story, but in the short term, we're kind of getting a little bit ahead of where we might normally reasonably expect given the trajectory of the future earnings growth. So for now, pretty distributive pattern in the short term. Again, candle patterns on their own are more just telling you about the next 1 to 3 bars is usually my general way of thinking. So suggests weakness going into the weekend and the beginning of next week as well. Again, very interesting that this is happening right before we have Jerome Powell from Jackson Hole, and I'm sure trying to communicate data dependency and having all the tools they need to make sure a soft landing plays out. He will describe that in very powerful ways. But in the Q&A, if there is any, or in the comments, what people will be dissecting is what sort of confidence investors have in the Fed's ability to actually make those changes as needed. And again, higher rates seem to be the rule, not the exception for the foreseeable future. Let's look at some of these in a little more detail, some of these individual stocks. NVIDIA today, and I'll zoom in a little bit. Actually, why don't we go to the ACP platform and bring up an NVIDIA? So here we're looking at the weekly chart on the right, and I'm looking at the last, we'll call it 5-6 years. Here's the daily chart in the lower left, and in the upper left, I just have a candle chart just to briefly look at today's action. And if you look, right, I mean, the couple days leading up to NVIDIA's reports, this was Monday, Tuesday, Wednesday session, certainly appears to be some short-term strength, right? And there's some optimism going into the earnings release. And well-founded, right? I mean, if you look at NVIDIA in 2023, I mean, this stock has gapped higher 10, 20, 30%-ish on a good earnings day. So, I mean, there's precedent just in recent history for NVIDIA to do well, given optimism. There's a bullish engulfing pattern here back on the 14th, sort of beginning this little rally here. While it's not a particular candle pattern I'd probably care to articulate, what I would say is this 2-bar pattern tells you all you need to know about the market's expectation for NVIDIA's report and what investors are actually treating, how they're treating the stock after the information was gained. Yesterday, we were closing toward the highs of the day, plenty of optimism in the last week. Today, we gapped up to above 500. We were trading even higher in the after-hour session yesterday. So gapping well above yesterday's close, but by the close, we're almost right back to yesterday's close, right? So all of that optimism basically provided NVIDIA shareholders a great opportunity to sell and or short positions to be open, whatever it was. People were thrilled to be unwinding a position in NVIDIA around 500. That was a gift. is what the market is telling you. So this sort of pattern is not a wow, NVIDIA's bullish type of pattern, in my opinion. This is more of a sign of the dynamics right now. This is telling you in the short term, the sentiment's more bearish than bullish. This represents traders selling the rips as opposed to buying the dips. I think paints a picture of a little more of a distributive pattern for stocks overall. Now, I mentioned the S&P, the NASDAQ with the bearish engulfing patterns. As you could probably guess by the fact, or by how these benchmark indexes are weighted, big names like Microsoft and others showing a very similar pattern. Here's Microsoft bouncing off the low almost a week ago, trading higher going into today's session. We gapped up and opened right at the 200-day moving average, traded slightly higher, but by the close, we have engulfed the previous day's action. So a bearish engulfing pattern on its own is certainly, a sign of short-term weakness. But the fact that it happens at a key level, right? So when a stock is trading up to the 50-day, the question is, do we go through resistance or just trade up to resistance? And this seems like the latter. This seems like some of these key names trading up to an important level and then pulling back. And again, I think that tells you the short-term dynamics that we're in right now. I'll go to Tesla next just to kind of illustrate a little different sort of take. I mean, not necessarily a meaningful candle pattern today, but I just want to highlight the fact that a chart like Tesla is actually just coming out of that oversold region. Here's the daily chart. You can see the RSI here going slightly below 30, and that was a couple days ago. And you can see now the bounce that we've had this week as the stock bounced out of that oversold region. I heard some buzz when stocks like Tesla are oversold saying, all right, that's probably the end of the move. This is probably where the pullback ends and we go higher. And I think a lot of times traders get in that trap of oversold is bad, oversold is good, meaning we bounce higher. Overbought is bad because we're probably going to come back down. That could be a short-term dynamic, and you've seen Tesla bounce over the last couple days after coming out of that oversold region. But what you have to remember is, in a distributive phase, a stock will often become oversold. And that doesn't mean that the big phase is down. That just means that push is probably near the end of that leg down. And what I mean is, look back at the third, fourth quarter of 2022 for what could be an analog for what we see. I don't want to say that we're going to repeat this period and have a same parallel move. I don't think we could make that sort of claim, but I would say look at what happens in a downtrend phase. When a stock like Tesla is going lower, you will find these down legs, what we call an impulse move, a move in the direction of the trend. You become oversold, you come out of that oversold region, that's a brief bounce higher to make a lower high, and then we make a new low. We again become oversold, we bounce off of that level, we make a new low, we become oversold, and you see how this pattern kind of goes. Those oversold conditions are not telling you this larger trend is done. It just tells you that push lower, that impulse move might be nearing an end, and you might have a corrective wave or a brief wave, a counter trend move, right? A brief move away from the trend. I would argue with a lot of these growth stocks, I would speculate this is probably what we've seen in some of these. A lot of these names became oversold. We see a bounce as a result of that. It's actually totally normal. That does not mean we can't have at least another leg down, even equal to the first leg that we've seen. These indicators can help you identify the short-term swings, but may not be enough yet to tell you that that larger trend may be exhausted. That's it for our market recap today. A number of things we had to talk about, given the distribution going into the close. I'm going to bring on today's guest, Sean McLaughlin, here in a moment. Before I do so, a couple quick announcements. First off, our mailbag is always open. We love to hear from you. Appreciate so much your feedback on our show. Thanks for the support as we go back live this week. We'll continue to do so. Excited about what we can do with the show going forward. But our mailbag is fueled by questions coming from people like you. Would you send us your questions? Anything about technical analysis, about the Stock Charts platform, about market history, whatever it is, we're here for you. thefinalbar@stockcharts.com is our email address. That's the best place to go. On Twitter or X, you can tag us at FinalBarSCTV. And on our YouTube channel, of course, just drop a comment below the video you're watching on our Stock Charts TV channel. Also, to let you know, we had a great live Q&A on Wednesday. We'll do another one next Wednesday at 1 p.m. Eastern. Mark your calendars. Save the date next Wednesday, 1 p.m. Eastern, 10 a.m. Pacific. Of course, on our YouTube channel, if you go to the live upcoming events, you can set a notification so you'll know when we go live next Wednesday at 1 o'clock. Also, as a reminder, tomorrow and Monday, I will be out on vacation, hopefully taking a well-deserved break with my family. We're going down to Mount Hood. Now that the smoke has kind of dissipated in this region, hopefully, we'll have a nice time hiking around and enjoying the great outdoors a little bit before school gets back in session. Tomorrow, we have a special episode for you called The Top 5 Ratios All Investors Should Follow. Just a little bit earlier today, we recorded some really good ideas about some different ratios. I would not miss that one. That'll be a lot of fun. On Monday, I want to thank in advance Ms. Schneider of Market Gauge, who has generously agreed to guest host the show. She'll be hosting remotely from Santa Fe, New Mexico. She's awesome, has a lot of great experience behind all of the charts and comments she'll share with you. I would tune in on Monday, then we will be back live as normal from the studio next Tuesday. I want to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at AllStar Charts, coming to us from Boulder, Colorado. Recently back from a whirlwind tour through the Asian continent. And welcome back, Sean. How are you?
Hey, Dave, it's great to be back. And I'm a little jealous you're going hiking with the family next week. That sounds wonderful.
I did. I looked up and I saw you getting ready, and I was like, I should mention this because I know Sean will appreciate it. I mean, in another area of the country with some brilliant hiking and beautiful mountains, so it should be a lot of fun. It's going to be good, and it'll be good to get away a little bit. Let's talk about the market conditions here. Obviously, today an interesting day to come on the show. I appreciate you doing it. We the expectation, I think, coming into today, a lot of optimism because of NVIDIA with good earnings. You're seeing distribution through the course of the day. When you take a step back and look at where we're at, what are you thinking?
Well, I hate to draw parallels to times in the past, A, because it shows my age, but B, we can always come up with these things. But this whole NVIDIA business with them changing the world with AI and everybody watching it and the monster run that it's had, it has echoes of Qualcomm in the late 90s, right? When Qualcomm was ripping and doing its thing, and Qualcomm had a great business. They were making money, which not every internet company could say back then. But they became one of the darlings and had a monster run, and everybody raised their price targets. I think there was a crazy $1,000 price target out there by somebody. And when Qualcomm peaked, it didn't mark the top of the dot-com bubble, but it basically put the nail in the coffin. And I'm not saying that we're heading into some kind of crazy bear market here and the AI thing is over, but what we saw in NVIDIA yesterday with all the hype going into the earnings, I'm not a fundamentalist, David, you know that, but man, it kind of raised my hackles a little bit. I feel like I've seen this movie before.
I was going to say there are a lot. I mean, the longer we've been doing this, just like you think back to previous times, and there was certainly that hint. I mean, and we've seen it, I think, up until now, where you have a lot of these growth stocks that have already had these runs, and we talk about overvaluations. I remember, yikes, 23, 24 years ago, late 90s, you're having these same discussions about higher valuations and everything like that. With that in mind, let's talk a little bit about the volatility, because the volatility has started to pop higher. Do you think this is the beginning of the VIX going further, or is this just a blip in terms of a little uncertainty? And what does that do for you and your approach?
Well, David, you kind of hinted at this a little earlier about how the VIX today, what is it, 16, somewhere around the 16 it closed today. While that is higher than where it's been over the past 2-3 months, certainly, and that's not insignificant. The VIX is really now just feels like it's getting back to its historical norms, right? And I think you and I talked about this last time I was on your show a few months ago about how for the long history of the VIX, generally speaking, 12 to 20 was kind of the range that we always kept an eye on, right? 12 was the low end. That's when markets are calm and everything's smooth sailing. And if VIX got up to 20, that was kind of like, hey, that's the red alert zone. Things are getting dicey. It's risky out there. And VIX generally stayed in that range with the occasional pop above 20 from time to time. And I feel like the last 3 years, for whatever reason, VIX held above 20, and that just conditioned investors to think that that's normal. And I think now we're just getting back into a normal range for VIX. Yes, VIX at 17 compared to where it was 2 months ago. Yes, it's high and it's elevated, and we are, at least at our shop here, we're looking for opportunities to sell premium. But I don't feel like it's red alert levels, nothing we need to be freaking out about yet.
What would you see from the VIX where you would say, okay, this is freak out levels? Is there a particular level that you would hit, or is it more about the dynamics in the market kind of surrounding the volatility going on?
It's both, right?
Yeah.
I mean, if I had to pick a hard number for VIX, if we got above 20, that would be very concerning to me.
Yeah.
Um, but more to the point, I would want to see stocks breaking lower out of what is currently a pretty sloppy range. And kudos to you, David. Earlier, you mentioned it, and I agree 1000%, especially in my time frame. Anyone in a swing trade or longer term time frame, it is so hard shorting stocks. If you're a day trader, great. Shorting stocks is actually a wonderful thing to do. In fact, when I was a day trader early in my career, I always made the most money on the short side. But outside of day trading, man, being a short seller is a really hard business. And so when we get into market environments like we're in now, yes, it's tempting to go looking for stocks to short, but my experience is telling me as an options trader, where I'm better served deploying my capital now is to be looking for opportunities to get into delta neutral plays and selling options premium and betting on range bound action, because at least me personally, I have far more success doing that in choppy markets that we're in now than I do getting aggressively short.
Yeah, no, well said. And I appreciate you talking through some of that, Sean. Can we talk about a couple individual names? We mentioned Microsoft in our recap earlier. Obviously, trading higher, gapping higher at the open, trading lower with a lot of the other growth space. When you're looking at Microsoft in particular, where does the opportunity presented? How are you approaching something like this?
So I had you bring up a couple charts. Microsoft is one, FCX is the next one. And what I just wanted to bring these charts up as examples of the types of charts we're looking at now, charts that are not incredibly bullish, but certainly aren't yelling at you at, selling, this is where we want to get super bearish here or get short. These are charts that are, well, for lack of a better term, messy or sloppy and setting up for what we think is going to be sideways action. And so with elevated options premiums like we're seeing now, again, options premiums have been higher over the last 2-3 years, but compared to where they've been for the last 3-4 months, we're seeing great opportunities for the first time in a while to be selling options premium in a lot of ETFs and big cap stocks. I don't recommend selling options premium in smaller cap stocks, certainly not a biotech or anything that you could have crazy overnight news. But if you stick to the big caps, like a name like Microsoft, when there's premium to sell, if you could do it far enough away from current market action, they set up for very good risk adjusted returns. So Microsoft is one example. If you want to bring up the FCX chart, that's just another example of charts that we like in this kind of environment. Like, hey, we don't think these things are going higher or lower. We don't feel strongly either way. We're betting on these ranges to stick at least for the next 4 to 6 to 8 weeks, hopefully. These are the types of bets we're making right now.
It's interesting with both of these names. I feel like, we so often, when you look at a chart, I know I fall into the trap sometimes. Are you bullish or bearish, right? Is it going up? Is it going down? And I think more often than not now, and you're maybe seeing it with rates kind of being range bound over time. We're seeing it with a lot of individual stocks as well. When you're looking at a chart like Freeport McMoRan, can you put a little more detail in terms of what about this chart tells you this is a good opportunity to collect premium and bet on that range? And what would tell you that that's changing? Is it as simple as we break out of that base one way, or how would you kind of approach this? And what would tell you that the conditions are different, I guess?
Sure. There's a number of things I like about this chart for selling premium. Number one, for the last basically since March, we've been in a range bounded by about 45 at the upper end and about we'll say 35 at the lower end. That's, these are approximate numbers, but that's a range that is held for 4, 5, 6 months. And look, I believe in inertia. Things like to just keep doing what they've been doing. In this case, it's been going sideways. It's kind of you see it in the 200-day moving average you have shown there. It's a relatively flat 200-day moving average, and we're trading right at it right now. So that tells me those two things tell me that we're in a rather trendless environment. Now, what would change my mind? Oh, actually, before I get there, the other thing that I liked about this chart and why I'm selling premium. You don't have this showing on this chart here, but I track implied volatility, which
Mm.
basically is a measure of options premiums. And implied volatility in FCX is not at the highest level it's been for the past year, but it's way off the lows of where it's been. So that makes it an attractive candidate to sell premium because implied volatility, mean reverse. We can go down a whole side road on that if you'd like. But those are the reasons why I like this chart. And what tells me I'm wrong? It's a really simple answer, David. And you know this, only price pays. If we see FCX break above 45 or below 35, those are my signals that I'm wrong and I'm going to exit the trade and get out.
Well said. No, thanks for talking through that. I really appreciate it. And so great insights on FCX. There's that idea of a range-bound chart. We only have about a minute left, Sean, but I'd love to ask you this. Zero DTE options, the 0 days to expiration options. I have been told they are either the best thing that's ever happened to options traders ever, or they are the most evil thing to ever happen to the financial markets. How would you respond to that, and what do you think that does to the dynamics of the options market going forward?
Well, I think it's much ado about nothing, David. When the entrenched players when new things come out, the entrenched players who've done things the old way forever, they tend to look at new things as scams, right? But you can't argue with the fact that 46% or something like that, or maybe higher than 50% of total options volumes right now is happening in options that expire today or tomorrow. That is unbelievable. There is plenty of liquidity there. And if you're a trader, you love liquidity. You want liquidity. So there's nothing to hate here. And I should point out, because smart people ask this, they say, well, if all the options volume is happening in options that expire today or tomorrow, is that cannibalizing all the other options volume? And so far, at least with the things I've read, that hasn't borne out. The options volumes in the later expirations are still trending higher the way they have been for decades. But really what's changed is there's whole new volumes coming in. And the bad rap on 0 DTE early on was that, it was all the day traders, it was all the retail traders coming in. And that was true in the beginning. But Morningstar had a piece out a couple of weeks ago talking about how the profile of the average trader has changed. It's more institutions, it's more large hedge funds that are protecting themselves against event risk. Whether it's a government report or earnings or whatever, it's being driven more by institutional players. So I don't see how that's a bad thing, David. I think we all win, and whatever brings more volume to the markets is always a good thing.
Liquidity doesn't seem to be a bad thing in most cases for investors and for traders. Sean, what a pleasure to be able to ask you some of these questions. I really appreciate you talking through some examples. Be well, stay safe there in Colorado. We'll talk to you again soon, all right?
All right, enjoy your hikes next week. I'll be thinking of you.
Thanks, Sean. Sean's the chief options strategist at AllStar Charts. Sean McLaughlin coming to us from Boulder, Colorado. And again, really helpful thinking about, what I find with a lot of equity investors, options feel like this confusing, unfamiliar territory if you've not traded them before. Talking with someone like Sean, you realize how accessible they are. And certainly the options, pun intended, that it gives you, right? The levers that you can pull. As a long-only stock picker or equity investor, you're saying, do I want to be long or not on a particular chart? With options, you have a lot more things that you can try to play, a lot more opportunities to protect capital and to have some gains, even if the market is not necessarily moving how you'd like. Great take there, as always, from Sean McLaughlin at AllStar Charts. We have to wrap the show, folks, and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're keeping it simple. The S&P 500, I don't want to say this is the most classic topping pattern I've seen, and I'm not going to say at this moment that the S&P is going down to 3,800 or something like that. I think that is super premature. But what I will tell you, the dynamics of a day like today, you have to remember that the market has a trading day, and the trend in the market is all these different trading days kind of pushed together, and that turns into this trend that evolves. And so I find as a medium-term, long-term investor, I find a lot of value in seeing what happens and how the market anticipates news, how it trades during the news event, and how it reacts soon after, what sort of confirmation you can find. I am not super encouraged and optimistic about stocks after seeing what's played out through the course of this week. I think you're seeing an initial bounce after that sell-off in growth stocks. I think a day like today certainly reiterates the fact that we're in a distribution phase, that investors and traders are selling the rips at this point. I'm inclined to wait until you see signs of accumulation. That is not the way I would describe today's action in particular. Chart number 2, I mentioned the bearish engulfing patterns. This one chart shows you 3 of the most important names, all showing that same pattern today. Charts like Microsoft in the top panel, Meta in the second panel down, giving that indicator right below the 50-day moving average. They broke down through the 50-day. They're trading back up. And instead of breaking up through that level yet, what it's doing is actually giving that distribution candle. It's really suggesting short-term weakness. Others like Amazon are doing it elsewhere. It's actually doing it as it's testing its 50-day. But more and more names like this break their 50-day, as most of the S&P has now done in the last 4 weeks. I think that gives further evidence or further fuel to the downside fire. Finally, as we trend lower, what do? I would say now that we've broken those initial levels like the 50-day moving average, focus on key levels of support. I think Fibonacci retracements can be really helpful for that, for at least defining some level of downside risk and looking for opportunities to, revisit a particular stock that may be going against the alongside right now. But I would also say a trend line from some of the major lows can be pretty interesting. And right now, you have things that are well above trend line support. The S&P, take the October low for last year, the March low from earlier this year, it's around 4,200 right now for the S&P, around 420 for the SPY. There's a lot of room there left. Another 17 points on the SPY before we would break that level of support. The advanced decline line for the New York Stock Exchange actually really, really close, right at that trend line support. And things like the QQQ have actually already broken that level of support. So I think drawing some of those trend lines on something that has had a nice run can be a great way of confirming if the uptrend is holding or if we're starting to break down through support. The more of those trend lines that don't hold, the more I don't want to be optimistic about charts for now. Let's wait for the markets to turn on their own. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Special thank you to Sean McLaughlin of AllStar Charts joining us from Boulder, Colorado. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.